We're talking about net changes in central bank gold reserves with Jeff Christian, managing partner of the CPM Group. Jeff, welcome back to the show.
Good morning, David. It's good to be here.
Good morning to you, too. Now, let's look at the data that you've presented here, and let's just run through a quick summary. Net changes in gold reserves in 2021, year-end, year-to-date 2021, and year-end 2020. You've got the biggest increases in reserves from Thailand, Hungary, Brazil, everything on the left-hand side of this screen. On the right-hand side, you've got the biggest sellers of gold: Turkey, Philippines, Russia, Germany. And interestingly, I've noticed some of the biggest buyers of gold in 2019, including China, are not on either of these lists because China has not changed its gold reserves last year. So just on first glance, what can you tell us about this data here and sort of the shifts in global reserves of gold that we've seen in the last year or so?
Well, let me start with one very important fact. These are monetary reserves of gold. Various governments have strategic reserves and reserves that are not owned by the central bank, or they might have gold investments in their sovereign wealth fund. These are monetary reserves of gold. And what we're seeing this year, in the first half of this year, the first 7 months, is more central banks are buying more gold at higher prices than they have in the past. So the price sensitivity that we've seen in central banks toward gold, with the exception of China, which we'll get to, is gone. And if you look at, traditionally over the last 13 years or so, central banks are more price sensitive. So when the price rises, they pull back. But what we've seen is a number of central banks like Thailand and Hungary, they have domestic political issues. Hungary has international political issues. They're under some problems. And so they're converting some of their foreign currency into gold. Thailand has domestic political issues, and they're converting some of their money into gold. The rest of the list of buyers is very interesting because it's spread around the world. And you have countries like Mongolia and Cambodia, but you have Egypt in Africa, you have Brazil and Colombia in Latin America, you have Serbia, Czech Republic, and Hungary in Europe, and you have Australia. So you have a diverse group of central banks that have not been gold buyers for decades, stepping up and buying large amounts of gold. And very importantly, they've been buying at prices like 1780 to 1840. So, the message that we've been giving our clients is central banks think $1,800 is a low price or a good price at which to buy on a long-term basis.
Yeah, but you made the point that some of these countries like Thailand, Hungary, you've noted, they're buying it because they have political turmoil. So maybe they don't have a choice. It's not like they're bargain hunting right now. They just need to convert, right?
No, they don't need to convert. And in fact, it's fun. Years ago, 30 years ago, Ireland was having some financial issues, and someone from the gold industry went out to a press conference that the Irish Central Bank was having and said, you should buy gold with your few remaining foreign exchange reserves to prove that you have the stability and solidity of gold in your finances. And the central banker said, no, that would be the last thing we'd want to do. We need currencies to defend our currency. And a lot of people would look at us putting what few currencies reserves we have left into gold as being counterproductive. So, I don't think that the political turmoil forces them to buy gold, but it stimulates an interest in diversifying their portfolio of monetary reserves away from currencies to have more gold in there. And none of these countries, I don't think, are really putting particularly large portions of their monetary reserves into gold. Most of them have very low amounts of gold in their monetary reserves, and they're just building some exposure to gold. The same way private sector investors and corporations and investment funds have been increasing their exposure or building for the first time exposure to gold.
Let's back up a minute and just talk about, generally speaking, why central banks around the world need to change their gold reserves, either selling or buying. I know that's, it varies on a case-by-case basis, but maybe you can help us outline some of the general motives.
Yeah. I mean, most central banks fall into one sort of category, and yeah, there are permutations from country to country, but it's pretty much the same. Russia and Kazakhstan and Uzbekistan are sort of outliers in that Russia is facing a lot of sanctions. It has a lot of hostility geared toward it, especially from the United States government, but also to some extent from the Japanese and European governments. And Russia has a cultural issue which is reflected in government policy, that they feel that the rest of the world hates them, and they're always feeling sort of a state of siege there. So Russia is actually the one country that's an outlier that has been buying a lot of gold from its foreign exchange reserves. When the oil price fell in April of 2020, they stopped buying because they needed the cash to run the government. Now and that's why they sold more gold in early 2021 because of that. Now the oil price has risen up, although it's off $10, in the last couple of weeks. The oil price is over $65, or $60. It's going down fast. So they're in better position financially. So they haven't been selling recently. Other central banks look at it, and you use the wrong verb. They don't feel that they need to buy gold. They feel that they want to buy gold. They want to diversify their monetary reserves. Most of them, and we haven't talked about Turkey, we haven't talked about China. Those are interesting developments there. But most of these countries don't necessarily see gold as being integral in monetary policy other than as a monetary reserve. And they're diversifying their portfolio. Yes. And they're diversifying their portfolio because, a lot of them were bearish on the dollar and have gotten it wrong. The dollar hasn't fallen nearly as much as some people thought it would. But the volatility in currency markets has increased. So the central bankers simply say it probably makes sense to have some portion of our reserves, a small portion of our reserves, or as the Chinese government said in 2015, a small but significant portion of our reserves in gold, just to diversify our portfolio.
Yeah.
Again, same way that private sector investors and sovereign wealth funds and corporations do.
You brought up a key point, which is volatility in foreign currencies. So let's take a look at this chart one more time. I'm surprised to not see countries like Venezuela and Lebanon on the left-hand side of this screen as high net buyers of gold, given how much their currencies have depreciated due to hyperinflation. Are you surprised at that as well?
What was the second country? I'm sorry.
Venezuela and Lebanon.
Okay. Yeah, it's funny because both of them used to have a lot of gold, and both of them have sold a lot of gold. Lebanon in the 1970s and 1980s. Lebanon prior to 1974 was like the gold center of the Middle East. But political instability ended that. And they had like 21 million ounces of gold reserves back in the 70s. They've sold most of it off over the years just to survive. Venezuela is the same thing. They had a lot of gold. They sold a bunch. They brought it back. Then they had to try to lease it out. Then they couldn't do that. So there was a bunch of gold that seems to have disappeared from the monetary reserves of the government and gone into the monetary reserves of some of the socialist leaders of Venezuela, which then showed up in Uganda trying to be re-refined and pawned off as artisanal gold production from various African countries. So Venezuela doesn't have a lot of gold. I mean, they tried to use their gold, and they did for a little while, but they pretty much used it all up.
We used it for what, Jeff? I mean, it's interesting. If you were the central banker of Venezuela or Lebanon or any country experiencing such hyperinflationary scenarios, what would you do to stabilize your currency? Would you buy your gold? Would you buy more gold to keep in reserves, or would you do, as you've described, sell their gold for whatever purposes that they may have?
Well, it's not just inflation that you have to worry about. And Venezuela and Lebanon are somewhat different countries. But if you just look at the case of Venezuela, its exports have plunged. Its oil production has plunged. because of mismanagement in the oil industry, really starting with Chavez and going through the current regime. So you have a country that is starved for foreign exchange reserves, and that means it's starved because it imports a lot of food, it imports a lot of things other than oil. Its exports have collapsed, its imports are more expensive, and the country needs to feed people at least rice and beans to keep them alive, or otherwise, you have heads on pikes outside the government offices. So you don't have reserves to put into gold, and it doesn't make sense to put reserves into gold. It makes sense to use your reserves for the reason why you hold them as reserves, which is to try to help the country. So if you want to fight hyperinflation, you don't do it necessarily by buying gold. You fight the root causes of that hyperinflation. Now, the Venezuelan government has chosen not to do that, so they continue to pursue policies, fiscal policies and social policies that are further just damaging the country, the same way the Zimbabwean government did under Mugabe. So no, if I were running a country like Venezuela or any other country, yes, and I never will, but if I were, and I had that kind of fiscal and economic crisis, I would not be taking scarce monetary reserves and buying gold with it, because you don't necessarily prove to anybody fiscal responsibility by taking scarce reserves and putting them in gold, which is less liquid than the dollar at a time when you need dollars to try to help stabilize your economy and improve things.
Well, some economists I've heard have made the argument that a gold standard is one option for stabilizing one's currency. Now, first of all, is that true? And second point, do you need a large gold reserve to peg your currency to gold? Is that necessary? So first part of the question, gold standard, is that good for stabilizing currency? Second part of the question, do you actually need reserves for a peg?
You've learned that my short-term memory is gone. No, gold reserves do not, a gold standard does not stabilize a currency. If you look at the United States when we had a gold standard, 1870s through 1933, we had an extremely volatile economy, much more volatile than we've had since we went off the gold standard in 1971. If you go back and you look at that, we had periods in the 1870s, 1880s, 1890s when we had severe depressions, and we had bouts of hyperinflation. And the part of the reason was because we were on a gold standard, and there'd be periods of time when there were shortages of gold, so that you had hyperinflation, and then there'd be periods of shortages of gold when you'd have deflation and depression, and then there'd be periods when you had a surfeit of gold and there'd be hyperinflation. So having a gold standard doesn't help it. And there's a lot of nostalgia for the good old days of a gold standard that is held firmly by people who clearly don't remember or have never studied the economic volatility that we saw during the gold standard. And inevitably what happens is, if you do have a gold convertibility in your currency and you're in that kind of economic situation, and you've seen this country after country, you saw it in the United States in the 1960s, if you have those kinds of economic problems and you have your reserves, your currency convertible into gold, what you find is that people say, here's your currency, give me your gold, and you lose your reserves. So if you were a country like, say, Venezuela, and you had gold reserves, and you said, okay, I have a lot of economic problems, I'm going to go to a gold standard, and my currency is convertible into gold, anybody who had your currency would say, give me your gold, here's your currency. Yeah. And you would be in much worse shape almost immediately.
Really? So, well, I guess I know the answer to the next question, but I'm going to ask it anyway. It's been 50 years since the U.S. has been taken off the gold standard. Do you think we should go back to another one, some sort of peg, some sort of anchor to gold?
No. I mean, I'll be talking about this on our Friday video for CPM Group, because I talked about it last Friday and I got a couple comments that were off base. And so I'm going to sort of try to clarify that. But no, I don't think that happens. If you go back and study the history of Bretton Woods gold dollar conversion, what you see is that we had all kinds of currency problems and monetary problems. We had a run on silver in the late 1950s that the Eisenhower administration punted over to the Kennedy administration. You had, enormous amounts of gold that were taken out of the U.S. Treasury in 1967 into April of 1968. And, it's interesting because in April of 1968, LBJ closed the private sector gold window. And he did that because there was a run on the dollar. People were saying, if you think that gold is only worth $35 an ounce, or that the dollar is worth $35 an ounce of gold, here's my dollars, give me your gold. And people were taking out tens of millions of ounces of gold from the U.S. Treasury. So LBJ closed the private sector gold window in April of '68. So when Nixon closed the what they call the public sector, which was central banks of other countries saying, here are your dollars, give me your gold. When Nixon closed it in August 1971, it was no surprise. But if you look at that period of the 40s and 50s and 60s, what you found was you had a very rigid currency exchange rate, which didn't reflect economic realities among countries. So you had constant official devaluations. And now what you have is a instantaneous devaluation. The market, the broader market, the free market, if you will, is constantly valuing the dollar and every other currency. And you don't have to have it under a gold standard or any other pegged currency standard, because you will see this, for example, in countries that peg their currencies to the dollar, and then it doesn't work and they have to devalue their currency. You have this sharp ratcheting down. So a pegged currency doesn't solve your problems. It masks your problems until they become even worse. And then you have to ratchet it down. So you don't have day-to-day devaluation of your currency. You have a sudden 5%, 10%, 40% devaluation. And that is extremely painful for companies and individuals who are trying to live and work in that country. So pegged currencies don't make sense.
Okay, interesting. Just one more point on this chart, and I have another question for you. Now, I'm reading data from the World Gold Council, for example, and they've listed countries, well, they've ranked countries by the percentage of their foreign reserves held in gold. And I'm getting a big range. For example, the U.S. is approximately 77%. You've got countries that are 3%. Why the huge disparity? Why is it that some countries hold a large percentage of the foreign reserves in gold and other countries just don't seem to prioritize gold?
If you look at the countries that have a lot of gold, they have gold really as a residual of the old gold standard days. So it's the major countries that traded up until the 1970s. Germany, France, England, Italy, the United States, Japan, Australia, and Canada used to have a lot of gold, but they sold most of it off.
Yes.
It was major countries that traded internationally during the gold standard days, the pound gold standard or the dollar gold standard. And they would take in gold as a way of balancing their international trade. Americans would be buying stuff in Germany and France and Italy and England and Japan and Australia, and they would pay for it with dollars. And then those people who were selling stuff to the U.S. would sell those dollars to their central bank, which would go back to the U.S. Treasury and say, here is a bunch of dollars, give me your gold. And so they accumulated a lot of gold during the gold standard days. The countries that don't have a lot of gold were not major trading counterparties or major trading countries during the gold standard days. And they're the ones that are buying, because they're the ones that are saying, well, we don't want to have 70, 80, 90% of our reserves in gold, but we do want to have some. If you go back to 1998, Switzerland had something like 98% of its monetary reserves in gold. And they said, we really don't want to have more than 50% of our monetary reserves under gold. So starting in 1999, they sold half of their gold. And then they said, and going forward, if the gold price rises and currencies devalue, we will continue to sell gold so that gold is always less than 50% of our monetary reserves. And that was their policy.
Right. So when you look at a chart like this, some people might theorize that some of these emerging economies like Thailand, Hungary, Brazil, they're buying a bunch of gold because they might be considering switching to a gold standard. How would you respond to such a theory?
It's a theory that is perpetrated by people who don't talk to central bankers in those countries or anywhere else. I don't know any central banker who seriously thinks that a gold standard makes sense.
Interesting. All right. Well, Jeff, thank you for your clarifications today. Good thoughts as always. I look forward to the next time. We have plenty more to talk about, I'm sure. See you next time. And thank you for watching Kitco News. I'm David Lin. Stay tuned for more.